Hello everyone, welcome back to our platform for investor education. Today we will be talking about mutual funds in two parts. Part 1 starts with why mutual funds. The old adage, never put all your eggs in one basket, is essentially the basis behind a mutual fund. A mutual fund can be defined as a financial vehicle that pools money from a large number of investors and puts that money into a wide range of asset classes such as equities, bonds, real estate. All these mutual funds have a stated objective as mandated by regulation. The stated objective is of investing in a particular asset class even before being permitted to collect money from those investors. The benefits of such mutual funds to an individual investor are: firstly, the difficult decisions of where to invest can be delegated to an experienced fund manager. Second, small amounts of money can be invested and at regular intervals. This encourages the habit of saving. Third, mutual funds offer exposure to certain stocks with high prices which an individual investor may not be able to afford on his or her own. Fourth, mutual funds offer the ability to diversify even a small amount of investment across a wide range of stocks. Let's look next at the background in India. Mutual funds began in this country in 1963 with the formation of the Unit Trust of India, UTI, which launched its maiden scheme the following year. Subsequently, the first major growth phase in the mutual fund industry occurred during the 1987 to 2003 period, when the first private sector funds as well as foreign mutual funds began to enter the Indian market. From the relatively modest size of these funds in 2003, the periods 2003 to 2008 and 2014 to now, 2019, saw the industry growing exponentially. The total assets under management as of November 9, 2019 stands at over 27 lakh crore, figure 1. This represents a 26% annual rate of growth over the last 50 years. A pretty impressive achievement, you would think. Of these, in the last few years alone, this growth has been fueled by the individual or retail investor who has entered this market through systematic investment plans or SIPs. These are just committed, dedicated, small amounts of money that are put in frequently, usually at monthly intervals. As figure 2 shows, SIPs have grown 3 times in the period from April 2016 to June 2019. The number of accounts under SIPs stands now at over 25 million. Monthly inflows come in at Indian rupees 80 billion as compared with 30 billion 3 years ago. This growth looks impressive, but it is our view that the runway is still very, very long. As we have mentioned in earlier videos, the conversion of savings into investment in our country is still very low. This conversion of savings to investment is what people often refer to as financialization. Still, what is remarkable is that the SIP growth has been stable, even though the equity market has been volatile, as figure 3 shows you. Let's look next at the taxonomy of these mutual funds. Broadly, mutual funds can be classified as open-ended funds or closed-ended funds. A closed-end fund issues a fixed number of shares which are listed on a stock exchange. Investors in the fund can buy and redeem their shares by trading on the exchange. The shares cannot be bought or redeemed from that closed-end fund. In the case of these open-ended funds, The investor deals directly with the mutual fund to buy and sell his or her mutual fund units. The units of an open-end fund are not listed on a stock exchange. If we go one level deeper, mutual funds can also be classified as equity funds or debt or income-oriented funds. Even within equity, the next level of classification typically invokes factors such as market capitalization and/or economic sectors. Within the debt-oriented class of mutual funds, the subclasses use notions of duration and/or credit risk. Duration is a financial concept that refers to how sensitive that mutual fund's portfolio is to fluctuations in interest rates. Likewise, credit risk refers to the likelihood of default of the companies whose debt securities have been held in the fund. Another way to think about this is that if one has a bullish outlook for bonds, then the investor should be positioned in long duration, high credit risk funds and vice versa in order to generate good returns. So when it comes to investing in mutual funds, let's think about how this works. One way is to subscribe to them directly through an asset management company. In this way, you visit their office, you visit a mobile app, or approach their website directly. The other way is an indirect method of investing in mutual funds. That usually happens when you go through a bank or a distributor of these mutual funds. In the former direct route, the commissions charged are much smaller, but you, the investor, will have to do the important and hard work of researching which funds to invest in. The indirect route, though more expensive, justifies the higher commissions by offering benefits such as fund recommendations, which funds to pick, and the ease by which you can make that investment. A how-to section associated with this topic offers more details on how to go about these plans and these choices. In fact, in India now, there are so many schemes. There are 40 asset management companies. The job of choosing mutual funds is a difficult one. I urge you to visit other parts of our content on this topic for many helpful hints on the subject. And I'm sure that will keep you coming back for more. Thanks.